Ever heard people say, invest in an ETF? Someone else says, no, buy an index fund. Another person recommends a mutual fund. And then on TV, you hear about hedge funds managing billions of dollars. They all invest in stocks. They all look similar, but they're actually very different. By the end of this video, you'll know exactly what each one is, who manages it, how much it costs, who it's best for, which one most long term investors actually choose. Let's begin with one simple idea. Instead of buying one fruit, apple, you buy an entire basket. Investing works the same way. Instead of buying one company like Apple, you buy hundreds of companies together. This basket is called a fund. The only question is, who decides what goes inside the basket? That's where these four investment types become different. Imagine you're hosting a wedding. Instead of cooking yourself, you hire a professional chef. You simply pay the bill. The chef decides what dishes to prepare, how much salt to use, what dessert to serve, what to remove from the menu. A mutual fund works exactly like this. You give your money to a professional fund manager. They research companies every day. If they believe Apple is expensive, they may sell it. If they like Nvidia, they may buy more. The goal is simple. Beat the market. Example, you invest $10,000. The manager spreads it across 40 or 50 companies. You don't have to monitor the market every day. The manager does that for you. Advantages: professional management, diversification, good for investors who don't want to research companies. Disadvantages: higher management fees. Many managers fail to beat the market over long periods. Now imagine something different. Instead of hiring a chef, you simply copy the menu from the most popular restaurant in town. No creativity, no experiments. Just copy it exactly. That's an index fund. It doesn't try to beat the market. It simply follows an index. For example, the S&P 500 contains about 500 of the largest listed companies in the United States. An S&P 500 index fund buys those same companies in almost the same proportions. If Apple represents about 7% of the index, the fund also keeps about 7% in Apple. No guessing, no stock picking, just copying. That's why index funds usually have much lower fees. Example, imagine the market grows 12%. The index fund will also grow close to 12%. Its goal isn't to win. Its goal is to match the market. This is where many people get confused. Many ETFs are actually index funds. The investments inside may be almost identical. The difference is how you buy and sell them. Think of it this way. A mutual fund is like placing an online grocery order. You know roughly what you're buying, but the final bill is calculated later. An ETF is like shopping in a supermarket. You see the current price and decide immediately whether to buy. Now let's move to the most misunderstood investment. Hedge funds are generally designed for wealthy individuals and institutions. Unlike mutual funds or index funds, they aren't trying only to own great companies. They use sophisticated strategies. For example, borrowing money to increase returns, betting that share prices will fall short, selling, trading currencies, commodities, options, futures, arbitrage strategies. The goal is to generate returns in almost any market condition. But with higher potential returns comes much higher risk. Example, suppose a hedge fund believes company A is overvalued. Instead of buying it, they borrow shares, sell them today, and hope to buy them back later at a lower price. If the price falls, they profit. If it rises sharply, they can lose a significant amount. Hedge funds often charge much higher fees than other investment vehicles and are generally available only to accredited or institutional investors. Imagine you're planning a road trip. Mutual fund. You hire an experienced driver who chooses the best route. Index fund. You follow Google Maps exactly without taking shortcuts. ETF. Same route as Google Maps, but you can hop on or off whenever you want. Hedge fund. A professional racing driver takes aggressive shortcuts, drives faster, and accepts more risk to finish first. For most long-term investors, index funds are popular because of their low cost and consistent market returns. ETFs offer similar benefits with the flexibility of trading during market hours. Mutual funds suit investors who prefer active management. Hedge funds are generally intended for sophisticated, high net worth investors who understand complex risks. Remember this one sentence. A mutual fund tries to beat the market. An index fund copies the market. An ETF is simply a fund you can trade like a stock. A hedge fund uses advanced strategies to try to outperform the market, often with much higher risk. If you found this comparison helpful, don't forget to like the video and subscribe.